All right. Morning, everybody. Welcome to Live Valuation. I'm Midas Moriarty. Today we're going to be covering Smith and Wesson. A little bit of a shorter stream today than normal. I know last time was technically a little bit of a shorter stream than normal, but this time probably even more so. And unlike some of the other times where I've said it was going to be shorter and then wasn't shorter, it actually probably will be shorter this time. Just because I'm not going to be doing so many years of data as I normally do, live anyway. The reason being is that I've actually already done a Smith & Wesson valuation last year, so all I gotta do is a lot of copy pasta of the previous years in, and then we just have to put fiscal 2020 in, which they just reported their numbers for pretty much just like yesterday or the day before. So it's really going to take not too much longer. I'm just kind of updating this one because according to my screening process, when I did a screen on the ones that take less time, this one was reasonably appealing. There's some prep work I wanted to do before I hopped into some other ones that I hadn't done yet. So yeah, I'm not sure how long it's going to take, but it may not take that long at all. But either way, Smith & Wesson, we'll see what's up with that one. It wasn't very appealing to me when I did it last, but it was in my old spreadsheet template that didn't quite have as much variability in fundamentals for each model to be able to really look at what could occur in worst and best case scenarios, and it also didn't have the probability distribution thing that I like to use for the models. So each model I did was fine, but they were all just kind of equally weighted, and I didn't really have it built into the system for that. And so it's very possible that I was overweighting the worst case scenarios. May have been overweighting the best case scenarios, but whatever. Point is yeah, there's. We'll see if it looks any different now. Not to mention, like I said, their fiscal year has ended recently, which last year was an extremely good year for Smith & Wesson. They benefited on the back of a lot of the social turmoil and the climate of the country in general. It was an election year. Gun manufacturers often do well in election years. It was the lockdowns that kind of drove a lot of people to want protection for themselves due to being stuck at home. There was a lot of stimulus money, which gave them the ability to decide to go out and buy more firearms. There was all of the protests, some of which led to riots. Whether one agrees or disagrees with that perspective of things, it drove a lot of people to purchase firearms. There was a lot of movements and attitudes towards police officers to change, and that kind of drove people to want to pick up more firearms. It was a perfect storm. A perfect storm of things going on in pretty much all sorts of corners of social life that was making it a really, really great year to be a gun manufacturer. Which, like I said, I had valued them in the summer last year at some point. I think it was like June or July, or maybe it was a little bit later, and didn't find them to be a very good value. But who knows? I could have been off for a number of reasons. My new template is a lot more different, so we're gonna get into that. But that probably isn't going to take as long as some valuations, because yeah, I just have to put in 1 year's worth of numbers and then do the analysis, and that'll be it, which is fine because I have other things I need to get to today. Yeah, so give me a moment to fix something stream real quick, and we will hop into it. I'll sort of keep rambling about the company a little bit as I go. The thing about that though is that because it was such a great year last year, is not in any way some sort of indication of what type of year this will be or years after that. If you look at the fundamentals of Smith and Wesson or other gun manufacturers, and look at their stock accordingly, you can see that they tend to move in cycles. This is definitely the type of company that does that because there tends to be a lot of conflicts and strife, and then there's years with less conflicts, and then they tend to recede during those time frames, and then it tends to come back whenever there's more conflicts again. And so it's the type of stock that does that quite a bit, and it is, relatively speaking, at the peak of one of these cycles. Now, as a general company, even a cyclical company, you would still sort of hope that in the long run they're moving upward over the course of things. So that isn't necessarily to say that they're actually going to be, going down, and that's the direction that they have to go or something. It could be that because if you look on their chart, they've been moving kind of sideways within their cycle for quite some time. So you could also argue that that's the cyclical pattern that it was in previously was essentially too horizontal, and it wasn't actually making any sort of solid upward moves over the long run. And so you could argue that this particular cycle could be part of the trend upward. It would still move in a cyclical pattern, but that cyclical movement might start to be more of an upward zigzag. That's definitely an argument you can make. So that's why, just because something is at the top of its quote-unquote cycle doesn't mean you shouldn't give it a solid look as a valuation. It just might mean that if you start purchasing into the company, maybe you don't want to purchase into it too heavily and make it a major position, because you could probably assume that there's a chance that it's going to drop off 30% or something as it moves downward with the cycle, and then you'd want to buy much heavier at that point. But on the off chance that it doesn't, and that this is a part of a larger move upward before it starts a new cyclical base, well, then you would want to have your position going. So either way, we're gonna do all of the numbers. I've got everything on the stream functioning now, I think. So we can hop into that. Keep permission running. Okay, so we're gonna start on with the segments, and as I said, I have all the numbers in my old spreadsheet, so really there's just a whole bunch of copy pasting that has to happen for a lot of this stream, but that's fine. It's fine with me anyway. Their industrial groupings, I kind of just, it's a pretty simple basis because I don't have gun manufacturers as an industry grouping that I have from my data set, but retail special lines / recreation, I think that makes basically the most sense as something you could call them. You could argue, maybe say it should be like 2/3 retail special line, maybe 1/3 recreation, but and some people will be like, oh well, it's not about recreation. Well, it's like, well, it is about recreation. A decent amount of these firearms are used for recreation, even if a solid large percentage of them are also not used for recreation. But either way, they do come out to be discretionary spending, definitely. And so I think retail special line overall fits the concept right that really well, and the recreation itself tends to be discretionary spending as well, so it's fine. And in the industrial unlevered beta, they're not that far off from each other. It does make a big difference in the sales to capital, and a decent difference in the adjusted margin, but not a crazy huge difference. So you can make your arguments about that. Perhaps it's a little bit too simplistic of a expression of their industrial groupings, but I'm fine with it. I think they came even closer during that. Sales to capital came down in retail special lines to make sense with last year. Or wait, that was recreation. My bad. Wrong one. That makes much more sense. Recreation came down very, very significantly last year. Retail special lines actually moved upward because of people having a lot of money. So in some ways they sort of switched places, but on the net, it actually did come downward a little bit. Margins on recreation also came down, and margins on retail special lines also came down. A lot of sales to capital moving upward for retail special lines, while the margins coming down actually does make sense, even if it seems a little counterintuitive. A lot more money went into the industry as a whole compared to the capital that was in the industry, but margins were still compressed regardless of that fact because of a lot of competition in the space. All right. All right, now let me copy over the geographic information for the equity risk premium. All right, I'll switch over equity risk premiums from previously. They do their production in the United States, but they do actually have revenues outside the United States. A very tiny percentage of it, 96%, from last year came from the US. We'll see what it actually ends up being. Or in the year previously, in the most recent year. But again, let me adjust the rest of these. A decent amount of adjust this as well. Got to put more lines in because previously I wasn't really doing this super smartly, where I was waiting. So I have equity risk premiums for Western Europe and I have equity risk premiums for Eastern Europe. So whenever a nation just says Europe, I sort of have to weight them appropriately. Previously I was just doing half and half, which doesn't actually make sense because Eastern Europe is a much smaller amount of GDP of the world. So now I sort of weight it approximately based off the GDP relative to each other, which Western Europe has approximately 4 times GDP of Eastern Europe. So that's what I'm doing here. I have to fit more lines in to take that into account. Otherwise, we would be weighting Europe a little bit too, well, we'd be weighting Eastern Europe too heavily and therefore punishing Europe's equity risk premium as a whole a little too much. All right, so that's the equity risk premiums based off of the revenues from the previous year. We still have to change out the actual revenues from the most recent year, but we'll get to that in a moment. Gotta go find it. Give us the international net sales, but they don't give us the US sales. But I guess we can just kind of net it out ourselves. Hold on. A little bit of math there. Looks like they did even less international sales than previously. Did I have that math right? I'm wondering where I got that number from, because it doesn't actually match up with what I have here. Interesting. Whatever. Okay. There's the revenue base equity risk premium, and then we're just going to use the US one for the production, which if you weight them together about 50-50, give a 4.74. Apparently my import information is being a little weird right now. We don't need to worry about that at the moment. We can deal with that later if it hasn't figured itself out. Now let's go find their debt numbers. I know I already scrolled past their lease liabilities. Don't remember seeing the debt. I might have just scrolled past it too fast. Maybe. It's all blacked out. I don't know. $4.1 years and 4.5%. Five. Okay, so they do separate into operating financing. That's good. $4.1 and then 17.5. %5 for financing and 4.5 for operating. All right, now if we can just find their debt. Again, I feel like I scrolled past it. Here's the cash flow statement. Well, let's just take a look at their balance sheet, see if that tells us what number we're looking for at least. Unless they paid it. Did they pay it all down? Maybe they did. Yeah, maybe they did. Is their leases our only debt now? See, that would be something that I would say, you know, that definitely could possibly put them into a positive upswing on their cycle if they've actually paid down all their debt through this last year. Yeah, oh, look at that. I don't see any debt other than their lease liabilities. Notes and loans payable right here. That's somewhat in line with the number that I have on my spreadsheet over here. Cool. Good for them. Good for them. They paid down their debt except for their lease and operating liabilities, which is only 67 or so million. And they have 16 years on weighted average to pay it down. Did bring their interest rate up because their actual interest rate on normal debt was lower than their lease interest rate. But that's sort of an implied interest rate. It's not actually like sort of super real. And you know, you have time. You have much more time with leases, typically speaking, than actual debt. So okay, cool, good for them. pushed their interest rate up, but it pushed their weighted average maturity way out. Because like over here on my old spreadsheet, it was saying that their weighted average maturity was 5 years, and they had 3.55%. So it pushed up to about 5%, which is a huge increase in the interest rate. But they also pushed the weighted maturity out to 16 years. And again, it was like 232 million, and now it's only 67 million. So it's also just a massive deleveraging. So cool, good for them. It might have been good to hold on to some debt because they might not have enough debt, but whatever. We can adjust that. I'm going to put this in place so that when numbers actually start to get in, it doesn't look weird. So now I just have to do a whole lot of copy pasting of the previous year's numbers. Oh, one other thing we want to go find is the RSUs, which I know I saw in here already. These. Where are they? When I saw them previously. Options. Not in thousands. Good. And Google Finance is like being all weird, sorts of weird today. I was trying to look at my portfolio earlier, and it's just like Google Finance internal error, Google Finance internal error. It's like, holy crap. Wow, still not working. Just do what you're supposed to do, Google, for like 3 seconds. There we go. Okay. So we begin the copy of pasta. They did also do, it looks like, a pretty significant amount of share repurchases with the extra cash that they had, so That could indeed backstop the the uh, uh, the value a little bit further. That could indeed be somewhat of an indicator of them actually having a broad-based upward movement in their cyclical pattern. Hush, Mikey. See. They actually paid 15, and then they have a forward of 8 cents, so could be 32. Hard to say for sure. Dividend information there correctly. All right, now let's copy over the balance sheet information from the old spreadsheet. Ooh, spreadsheet. Okay. Alright, so that's all the information from the old spreadsheet. Pretty sure. Now, can take a look. At their most recent year in their actual financial statements. That was here we go. But yeah, so you can see sort of right here I had hold on a minute. Hold on. Hold on a second. I see a problem here. It's like my numbers over here say that they're fiscal 19 or a year ending for 4/30/20, depending on how you want to state that. I'm not actually sure if that's their fiscal 20 or 21, but it doesn't really make a difference. But point is, I have 678. Other data sources tell me 678, but they're saying 529 here. I feel like this is the one from their website rather than the SEC. Am I confusing something? They both say that they ended April 30th, so it's not like they switched off their fiscal year ending or something. I'm sorry. Then here it is, 678 over here. What is going on? What am I? Gosh, Mikey, I didn't go anywhere. Just relax, dude. Lay down. My does not make any sense. Why is the form they have with the SEC different for the year previously? Does not make sense to me. Oh, like the 2021, the year that we're about to do, is just fine on both forms. I just don't understand why the year previously changed. Does not make sense. Negative 61 million. Negative 61 million. So like the net income is exactly the same. Net income didn't change, but for some reason the revenue is different. Like, why is the revenue different? That's weird. Doesn't make any sense. It's like exact same net income. How did their estimation of revenue change by like 150 million? What else changed? Cost of sales changed. Net revenue, gross profit changed. Not quite by 150 million. That's more like by 90 million. SG&A changed. Weird. That is very, very weird. I guess it doesn't make a huge difference if at the end of the day it comes down to sort of the same number, but just very, very weird. Because none of my averages are going to matter at that point. Because I'm going to use a net income margin average, which is going to be based around the reported net income and the R&D. So I guess that is, well, is the R&D the same? Sure about that. The R&D did change. What the hell happened? They like restate their form? For a 10K A form? Or they amended it maybe? I don't know. No? Maybe they changed their revenue recognition rules or something, then restated it backwards, but I don't know. It doesn't, like I said, I don't think it matters considering it leaves all the places where there's an average the same. Except for R&D is a little bit different, but I don't think that I'll change it too materially. Very weird. Very, very weird. However, like I said, I don't think it affects our specific valuation. That's just very, very strange to me. Might require a little bit further looking into. Yeah, assuming the number I had previously was correct, a 56% increase in in sales. Pretty huge. 37% increase in cost of sales, which is also good to see that the scaling up went well overall, making their gross margin on whole increase about 22.5%. That's a pretty significant jump up to about 42% from 34%. SG&A, let's add those together. SG&A actually came down rather significantly, assuming that number is correct, which would make sense with COVID overall, but the fact they managed to do that while upscaling their revenue so significantly is pretty awesome. R&D still coming in at a lower level as well, but again, it's hard to know considering maybe it's up from the previous year if that's accurate. I'm gonna have to look further into that, but it's possible I might have to resave this later and decide to redo this year, but I need to find out the exact reason of what happened there. Like why are the forms different? Why did they change? I don't really want to do it without knowing exactly why. But like I said, I don't think it's necessarily going to affect things that we do in our valuation moving forward. Especially since at the bottom line it ends up the same. I think if I had to guess, it's probably that they changed some part of their accounting practices. Yeah, it's probably a negative actually. Hold on. Right now, add together the change in operating assets and liabilities. All right, capital expenditures. Net debt and equity issuance. Yeah, so they paid down quite a bit of debt out of that very, very strong cash flow last year, which is good on them. You know, what that does mean is, because like I said, this is a very cyclical business. So this is a very, very strong year. Looks like they used it very intelligently because they paid down a huge amount of the debt, the vast majority of their debt, which means that when, you know, years come in the future where there's way less gun sales, then, you know, that means they're going to be in a good position to be able to be cash flow positive regardless of that fact. And then also it'll put them in a position to issue new debt if necessary, because then their financing apparatus, whatever partners they have in that part of their business is going to look at them and be like, oh yeah, well, you know, you're low risk, strong brand, you don't already have a whole bunch of debt, sure, we'll issue a loan, you know. So it's very, very good, very, very good management to realize that, you know, the good times don't always keep rolling. This is a very cyclical business. They took that into account. They didn't just take all that cash and just be like, oh well, we're going to give it all to the shareholders. They do give some to the shareholders, which we're going to talk about right now. Net treasury purchases. They did make a decent amount of treasury purchases. So they paid down their debt and they issued stock and they paid dividends. It's like, good on you guys. You know, you paid all of your capital holders. That's very, very good. Very, very good. Instead of just acting like, oh, these sales are going to last forever, they did the smart thing, paid down their debt. They paid out about $115 million to the shareholders in treasury repurchases and dividends out of the $141 of free cash flow to equity that we have available. So it's like they had a very strong amount of cash flow. They paid down $158 million in debt. And that left $141 million to still be available to the shareholders, and then they paid out about $115 million of that. So that means they kept back about $26 million onto their balance sheet of cash flow that could have gone to the shareholders that they decided not to. So it's like, yeah, you know, very, very good. This is what we call very, very prudent management of your cash flow. We'll see what it looks like at the balance sheet level, but very, very good job. Let's push this tax rate, see if I can't put it in a longer range average and come up with something that's reasonably positive. Not really, apparently. Partially because there's just outliers in here. So we'll kind of fiddle with it and make up our own sort of number. We use the 5-year average because that's actually a pretty good number, but what we're going to do is we're going to kind of cheat and just multiply it by -1 to turn it positive. And then I'm going to put some asterisks there so I remember that I did that. because this tax rate has to go into our terminal value, so we have to make sure it actually is a tax rate that makes sense, but it's being thrown off by years with losses where they still paid taxes, which is what we have going on like here, for example. So fix that by just kind of fiddling with it and making our own manual adjustment there. The 3-year average for the net income margin actually makes kind of sense, funnily enough, even though it's a little bit funny too. Is our longer term average comes out to like 9-10%. The longer term average is like closer to 10%. In the most recent 3 years, it's more like 6%, but that's being thrown off by the really strong year here, plus the negative year there. I think we'll go ahead and use the 5-year average then. The return on invested capital is also being super thrown off by this, partially because they paid down all that debt, which means that, well, actually, never mind. This number is not actually accurate yet because we haven't put in the balance sheet information. My bad. So we'll get to that first. Cyclical businesses can be weird for some of these numbers where I'm trying to use averages. That's just the thing they have to take into account. It's like that cyclicality makes using any sort of shorter term average really weird. The longer term you can go with that type of average on a cyclical business, the better. So, all right, so they end up with $113 million in cash versus 125 million there. And so, like we were saying, they actually kept back about 25 million of equity cash flow that they didn't pay out, but it didn't actually turn into cash here. It must have turned into other stuff. Not exactly sure what, but they might have spent it on something else entirely. Just not their debt, not on their shareholders, which is fine. Like I said, $113 million in cash when you're, which is you know, if you look at what the normal profit is in a year, that's fine. You know, that's perfectly fine. Their average over this like 7-year period that I have highlighted is 75 million per year. So having $113 million in cash means you've got a year and a half worth of profit almost. Your balance sheet is probably more than enough for them, especially considering they killed all their debt. It's like they have more cash than debt now, so that's great. Fantastic. They liquidated receivables. That's also good. But they didn't just build up, they didn't just get a whole bunch of sales at the cost of their working capital. Brought down their inventories, also very good. See, I can see that like they also have weird, odd restatements in this part of their information as well. I think this is probably where the confusion is this discontinued operations. I think that's where everything's getting thrown off. Because you can see, for example, the current assets is the same. The inventories are different. Cash is the same. Receivables are different. So it's like it's the discontinued operation that's changing the statements, I believe. Which means I feel fine just leaving it as is. Okay, that kind of eases my worries. If it had been the change in accounting principles, like I was talking about previously, or revenue recognition, which is kind of related, it had been one of those things. There could have been a situation where I did actually want to change the fiscal year 2019. But if it's that they spun off a piece of their business, they discontinued a certain operation, and so that's changing they changed their back numbers to reflect that. That makes me fine with leaving it as it is. That's fine. That kind of eases my worries about that a little bit. I was a little concerned if that was going to throw off my valuation or not, but now I'm not concerned with it anymore. So that's good. So the treasury purchases did come at the cost of their retained earnings and their shareholders' equity, but it's still in positive territory, so no big deal. In fact, it's still more than 50% larger than about 50% larger than their liabilities as a whole. No big deal. So lots of assets. The assets are more than double their liabilities, so no real concern there. Just something to note. It's better if you can do both share repurchases and increase your shareholders' liability or equity, in my opinion. But essentially, that's what you're doing when you do that. It's like shareholders' equity is the the saved up profits of the business, especially the retained earnings portion of it. And so, if you're paying out those profits to shareholders, well, of course, it's going to decrease that. And there's nothing necessarily wrong with that as long as it stays in positive territory. So that's fine. Okay, so we're done with that. Don't get too attached to that. We're near done. Yeah, so the debt to equity ratio is down to about 10%, which is pretty good to see. Means this is definitely overstated. About 25%, and then maybe the mid-range we can keep it around 10 to 15%. Leave it at 10. Open, use it. But with a relatively low industry beta and the very low debt to equity ratio, it means their overall levered beta comes out to be pretty small. What with their equity risk premium being relatively small, that does mean that their overall total risk premium is pretty small, which makes their cost of equity pretty small. And since they do have a pretty high interest rate, relatively speaking, but it's right kind of in line with that, makes their cost of equity not be super large either. Is good to see. Let's go back and take a look at those returns on invested capital. As I was saying, it did bring it down a bit, but it's still pretty outstated on that particular year. We might want to switch to a longer term average for that. Still a little bit on the outsized level because the numbers are a little bit chaotic, but at the same time, over the long run, it still sort of seems to be pretty large. The fact that they brought down their debt is just kind of making that even more so. So we'll just go ahead and leave it at the 5-year average. That sort of is what it is, but that does mean that they're producing pretty significant excess returns. It's like I said, financially speaking, they made basically all the right moves this year. That was a very, very good play, making a huge amount of money and deciding to not only return it to shareholders but also pay down your debts. It basically positions you for the next part of the cycle really, really well. So we still have other things to take into account, but very, very good and prudent management on whole. For net margin, I'm gonna bring this down pretty significantly because it's way, way, way too high. Numbers out there, but we gotta look. I had already went and looked at this. I swear it's like Google cannot just keep itself straight today. I don't know what's going on with that. Now I went and looked at the analyst projections for the company a little bit already. We'll take a look at it at Zacks as well. They only have a few analysts projecting for their years, but in this is what I mean by the down cycle. So everyone knows that this is an outsized year. So this in the next year, the analysts are projecting, or at least 5 analysts are projecting, a 25% decline in revenues this year. So it's like if you just kind of take that into account, brings it down to an average about 789 million is what the average is for 6 analysts in this particular year, and then 2 analysts are projected further than that, suggesting that it might drop back down to 551 million. So that also has to be taken into account, and that does kind of come on the backs of, like I said, the discontinued operation, which is part of the reason that this number has been put back downward. It was like 500 million or something. Essentially, people are expecting that in over 2 years' time, it would probably return back to the whatever this number was without the discontinued operation. So it's like if you kind of just do some multiplication and assume that, comes back down to that, yeah, about 556 million or 550 million. And then maybe you could assume that it would go back to sort of like a steady state at that point. Which means I would sort of assume that it would grow maybe perhaps at the risk-free rate for the years past that for 3 more years to get us to our 5-year figure, which would get me to about 581 million in year 5. Now if we do that, and divided out by 5-year CAGR, then that would suggest that they would lose about 11% of their revenues per year for the next 5 years. So that's essentially what the analysts are sort of expecting. Technically, they're expecting a little bit further than that, but I think that's fair enough. Technically, they're assuming they would lose it a little bit faster, but they also might be assuming there's a little bit of a further upswing further than that. So problem there. Hold on. Oh yeah, it's probably assuming that we lose all their capital over the course of that because of some of the other assumptions we already have inputted in here. Probably because of this. It ends up with a terminal capital of 0 as a result of that, which definitely doesn't make sense with their sales to capital. If you look over the course of their 3-year average, they have about 2.37% sales to capital ratio. If we use maybe a longer term average, 1.94, which incidentally their net margins and their sales to capital is kind of in line with what we found. We find that they actually have a on a little bit of a longer term average. They have a bit of a higher sales to capital ratio than what we were coming up with, and they also have a higher net margin on average too. So that's one thing to take into account. I think that's can be seen somewhat over just with the fact that they have a pretty strong brand as a whole. So maybe on the low end it'd be about 1 here. And see, by fixing that, that actually puts our terminal capital back into a positive number. So that's part of the reason why it kind of was freaking out when we put in the -20%. We can probably afford to do that now. Yeah, without it freaking out and deciding that you can't calculate it. And then maybe on the positive end of things, we could assume that perhaps there actually is a growth, which puts us in the mid-range of about 7.5%, which I think is maybe reasonable. I'm probably more bullish than the analysts are a little bit on this, but I don't want to take it too much into too strongly. Maybe even go a little bit lower on the worst case scenario. Maybe it's too far. But we also didn't adjust the upper bound, so that could be part of it. Well, it's not going to change anything because this number is going to be tied to this number. These numbers in the midpoint there, but that's probably fair. For example, if you look over the course of the years that we have here, the lowest their sales to capital ratio ever reached was 1. So that's probably in line with things. While on the upper end of things, obviously the most recent year was 4.74. It's probably unfair to put that as our actual top here, but 1.5 is definitely not. Maybe 3 would be a better number to use. You could maybe argue a little bit lower. 2.75. $1.5 for that. We'll deal with that later. Hold on. Hold on. Google just cannot function today, apparently. And that one. There we go. Double. Fine. We'll adjust the rest of them for that later, but on assumption that they'd have more cash than debt, we'll go ahead and give them a 0% in their best case scenario. None of the other ones, though. This should maybe come down. $13. Maybe bring this down a little bit too. Probably weight the distribution back a little bit. just to be a bit on the conservative side, assume that maybe there's a little bit more merit to the general idea that the analysts have about this. I'd maybe even wait back further from that as well. Just gotta be really, really careful about this whole cyclicality thing. Because like I said, part of the problem is that my spreadsheet isn't designed to deal with cyclical businesses that have very abrupt shifts like that. So like, for example, the idea that it's going to drop significantly in this most immediate year, I can't really take that into account because I'm just using a 5-year forward COGR, which is consistent for each year. And so if it's correct for this year, maybe for these first couple years, but then it's probably too far in these years, and then that means these years is probably not enough. But then maybe it makes sense by the end here. And so essentially, there's maybe too low of revenues in these years, but too high of revenue in these years. In those particular models, and I know I talked about this with some other businesses as well. I had the same issue when I was covering Coherus, as well as Qualcomm, as well as when we were talking about Apollo. All those kind of had interesting cyclicalities going on in their revenue based off of different things happening in the business. So it's a little bit tricky to project. My spreadsheet's just not designed for that. Maybe I'll have to like think about that whenever I make a new template in the future. Maybe I'll have a 5-year forward COGR, but I'll also maybe have like a special switch that I can turn on to essentially put custom revenues in for the first 2 years. For just 2 years in particular, especially because it also would allow me to essentially take into account the forward analyst expectations on that a little bit better. So maybe I might do something like that in my whenever I decide to rework my template as a whole and add new features in. That could be something I could do to have like a little on-off switch if I want to use a different custom number in those years or not. Let's see, anything else? I think I'm relatively pleased with this set of assumptions. Only thing left to do now is to change the default expectations. All right. Do you think that's it? Okay. Here's what I'm seeing Oh, hold on, hold on. There was they had a projection for the next 5 years, didn't they? This folder number here now. All right, whatever. Okay, so here's what I'm seeing for Smith & Wesson brands, ticker SWBI. The equity risk premium for the S&P 500 I'm seeing still at about 6.375%. That hasn't really shifted much over the last few weeks. It's like the equity risk premium moves up a little bit, and then the treasury moves down a little bit, and then reverses course, but that's just kind of been that way for a while. Whatever. The discount rate that I come up with for Smith & Wesson brands is 5.57%, a pretty low discount rate on the whole. They currently have a dividend yield of about 1.4%. I'm not 100% sure if that's going to be consistent or not, or if that's just kind of like a temporary plan. I haven't really looked into whatever announcements they've made around that, but it's relatively new dividend as a whole. 5 years ago, they had sales of $723 million, unadjusted for the discontinued operations that they had from the last year, but that's fine. I'm not really concerned with that. In the most recent year, they had a little over $1 billion in sales on the back of a whole lot of social unrest and various amounts of other things that basically made a perfect storm for their sales in the last year. Over that sales growth CAGR of about 7.9, almost 8% per year during that time frame. Sales to capital for the last 3 years on average has been about 1.94% compared to 1.86 that we would expect based off the industrial groupings that we came up with for them. Their returns on invested capital is about 27.71%. I believe that's over a 5-year period, which we're using as a decent average because the cyclicality in their business makes it a little bit more necessary to use long-term averages for that. Debt to equity is only about 10% right now. They did pay down a massive amount of their debt in the most recent year, which is very, very good and prudent management on their part. Basically, no default risk in the most recent year as a result of that. But if you look back over the longer term run, they have a little bit more default risk in some years and a little bit less in other years, which so we have a little bit higher number going into our forward-year model, but we'll get to that. Adjusted profit margin about 7.37%. I believe that was a 5-year average as well. And profit in the most recent year of about 248 million, which again is an outsized amount of profit, partially because of the outsized amount of sales. Their present price is about 22.92, and for our forward models, we have a distribution that weights a little bit backward from the optimism side to the pessimism side, partially just to be conservative because of the odd cyclicality of their business. And because of the way that my evaluation projects revenues, we wanted to make sure that we were covering some of the worst case scenarios a little bit appropriately compared to the way that they could play out, because again, we have an outsized amount of sales in the most recent year. So either way, that's probably we use is weighted backward a little bit, even though we are sort of bullish on the business, but we have to weight backward on the probability to take the cyclicality into account. But we're projecting revenues of anywhere from 347 million in 5 years to possibly 1.3 billion in 5 years, which gives us an expected value of about 700 million or so, which is a little bit less than, for example, where they were 5 years ago, but it's also more than where they were in the most recent 2 years before adjusting for those discontinued operations. Either way, that gives us a distributed revenue growth of about negative 8.65%. Again, just an outsized amount of sales in the most recent year, so there's nothing odd about that. That's just the fact that doesn't mean that they're in decline. It's just that's part of their business, is that they have really, really great years followed by laggard years, and that's just the gun sales business. Sales to capital ratio is we're projecting about 1.78%, which is a decline from where it was in the most recent few years, but is relatively in line with where they've been over the long run. In fact, you could say that we're being too conservative in that range based off of some of the positive end of things that they had. It's like our lower end model is in line with their worst year that they have on record for the years that we covered, but their best case is actually understated relative to that, but that's partially because this has to be a terminal number, so it could be a little bit higher perhaps in this case. Returns on invested capital is pretty high. It puts it in line with where it currently is over the long run, which makes I'm pretty fine with that. But it's interesting that they actually can sustain such high returns on invested capital, but good for them. Strong brand name, probably indicative of that. We're assuming that they very possibly take on more debt. Like I said, they pay down a significant amount of their debt, but this could reverse course because it's part of the cyclicality. It's good that they paid down debt in the good years because they very well might have to pick up more debt in the bad years. So the point is they put themselves in a good position to do so, but we're assuming that they will do so. Because of the fact that, like I said, in some of the worst case scenarios that their default risk does go up pretty significantly. We do have an adjusted probable default risk of about 1.25% for them per year on net, which is actually, pretty low all considered, because they have basically no default risk in some of these scenarios, but and partially because they did manage their debt in the good years. But so that's good for them, but that is a reflection of them paying down their debt in the good years. We assume that they'll keep their sort of long-term profit margin of about 7.6%. It's a little bit higher than what it was over that 5-year period, but again, they've prudently managed their debt, which will have a very positive impact on their net margin due to lower interest costs. This gives us a distributed profit for them of about 58 million, but that's partially because we're taking into account such a negative outcomes that very well might not be the best for the terminal number. Overall, it's the distribution of profits that makes more sense than the individual expected profit that we have here. Either way, with the discount rate we're using, we come up with a present value of about 29.56, which is almost 29% higher than its current price. And we have 5-year forward targets unadjusted for whatever dividends they choose to pay of anywhere from $20.79 to possibly $96.29 in the best case scenario, which gives us a distributed target of about $38.77, which based off the current price that it's trading at would give us an expected return for the next 5 years of about 11.08%, which is pretty good. Not amazing, but it's a little bit less than twice the market expected return. Not too shabby at all. It'll probably be very volatile, more volatile than the discount rate essentially implies, because again, it just has a very, very odd cyclicality to its business, and that cyclicality is not being reflected in the discount rate because we don't have an industrial grouping for gun manufacturers, which is very niche and very specific. So the industrial groupings which we aligned them with, which was more like retail, special lines / recreation, is not as reflective of that cyclicality as it otherwise could be. But so you could argue that perhaps there should be a higher discount rate, which would make the present value lower, but that would still make the expected return relatively probably about the same. It wouldn't change this part of it much. It would just change these parts of it, but these two would probably end up in similar ranges. The argument being that you should pay a lower price for those returns in the present, but you're going to get those same returns regardless if you had a higher discount rate. Our short-term multiple regression pricing metrics are a little bit all over the place, and it doesn't we don't have a analyst 5-year EPS expectation, so we don't have one for one of them, but overall it gives us a suggested price of about $25 per share, which is still upward from where it currently is, but not majorly so. But either way, like I said, that's more icing on the cake. We would expect about 11% returns per year, which again, not too shabby for such a cyclical, chaotic business that requires a huge amount of decline to take that cyclicality into account. But that's what Smith & Wesson comes up with. So yeah. Either way, like I said, this was going to be a shorter episode today, and we managed to get through it relatively quickly. We're only an hour and a half in, not too bad. But yeah, I'm pretty pleased with what I find here. Not good enough, I think, for me to take a bite out of it per se at this moment, but it is interesting that it's only a little bit above my worst case scenario 5-year forward target. That's pretty cool. Again, that is not adjusted for the dividends, so you'd have to take that into account, but it's a relatively low dividend. So it's like if you took the dividends out of this for 5 years worth of the current dividend or so, you might end up with like, I don't know, $19 or something. So it's like maybe if it managed to drop down to $19 or less, that would almost give you sort of like a worst case scenario protected price. So maybe that would be a point where I would consider buying in. At that point, this might be like 13 or 14%. I'm not sure what that would come up to, but that's not too bad. But, or you could also make the argument to not take a bite out of it unless it would drop below that price either. But the point is it's not bad, because it's still below most of my present values and even more of my 5-year forward target. So it's definitely not too bad. You just, like I said, with the type of business it is, you definitely have to expect that there's going to be some very, very volatile up and down swings. It's like, I wouldn't be surprised to see their sales drop to 500, 600 million in the next year, in sort of like the worst case scenario. And then perhaps the price takes a dive to like $15 a share or even lower, and then it might spike back up in 2 or 3 years again. So the point is you just have to take your buying opportunities when they come, but it is arguable that it is a buying opportunity right now. But either way, like I said, not quite good enough for me to take a bite out of it per se, but I'll definitely be paying attention to it. It definitely looks better than it did when I was using my old spreadsheet model previously. But that's part of the reason why I build new spreadsheet models, is to add new features that allow me to take other little details into consideration that I couldn't previously. But either way, very, very interesting company to look at. Like I said, I've been paying attention to it for like 2 years now. I'll probably keep paying attention to it. And who knows, maybe I'll look at another one in the business. I know there's also Sturm Ruger, ticker RGR. That's another one you can look at, or Vista Outdoors or American Outdoors, I think, is another one. There's a few other gun companies in the US exchanges that you can pay attention to. I'm definitely a very pro gun type person, so the idea of paying attention to the gun tickers is something that I like. Even though, yeah, it's definitely a risk depending on your views of the political climate and what could or could not happen. But the truth is whenever discussions about gun control come up, like they did a lot last year, it tends to result in very positive years actually for these companies, because people typically run out and buy as many guns as they can when those topics are at hand. But you could argue that that's a short-term boost for them, because if those types of things actually do happen, well, then that could put an end to their business, or it could drastically reduce their business, depending on what type of legislation we're talking about. So obviously, if you have one really, really great year and it's your last really, really great year, well, then that's not super great. But at the same time, if that's the case, then you could just be looking at the worst case scenario here and say that that's sort of what you're dealing with. But that's part of the reason we wait backward a little bit into some of the worst case scenarios, when, like I said, I think that the analysts are sort of expecting something in the range of like this, which on that basis it's still technically undervalued, but then its expected return is not as impressive. It's really only a little bit higher than the market return under that sort of circumstance. But yeah, so there's definitely a high variability in the potential outcomes for this one. Like I said, I was very impressed to see how prudently they managed their cash flow this year in response to that positive year. A lot of companies, where they have a really, really outsized year like that, even though they should know it's an outsized year that's not to last, and they should be expecting their revenues to decline the next year and the year after that and the year after that, a lot of times they make stupid decisions and they just keep all the debt they have while paying dividends and while buying back a whole bunch of their shares. So this company did buy back a very significant amount of its shares and did decide to pay a dividend. They also bought back the majority of their debt, and that's very, very good, very, very good management as a whole. So that's definitely one other very positive note to have on the Smith & Wesson. It's like, yeah, if you're going to have a business that's as volatile as this, you definitely want to have good management that understands that the good times don't last at the helm. And that definitely seems to be the case, at least for Smith & Wesson. So either way, that's going to be it for today. This has been Live Valuation. I'm Midas Moriarty. We do this 3 times a week, Monday, Wednesday, Friday at 10:30 a.m. Eastern. Not sure what we're going to cover on Monday yet. I'm trying to take my pick out of some of the other companies that we have in the screening process that we had done. Part of the reason I did this one today is because I wanted to do a little bit more prep work on some of the other companies that looked like they were options for ones to look at next, and I didn't. I thought it might take longer than 2.5 hours, so I wanted to do a little bit of prep work ahead of the normal 2.5 hours that I do for the show in general. But in this one, I knew would take much less time because I already had like 8 years of their financials already in spreadsheet form, so all I had to do was copy it over. So I knew this one would take less time, so I did it anyway. And so out of all the ones I had old spreadsheets for, this one looked like it possibly, out of my screen process, looked like it had possibly the best potential value to it. And it does look pretty good as a whole. So yeah, I'll catch you all next time.